Boom. And just like that, Pat, we are back in front of our millions and millions of viewers today. How are you?
Doing good. That your intro music is kind of catchy. It's got that kind of
It
like a
is.
beat to it.
Sometimes you just want to let it go and screw the show. Let just,
Yeah, and kind of was like, hope you let it run a little bit longer.
So we got a whole bunch of numbers and stuff to share today. And I want to talk about average when you hear, average number of listings, average number of home sales. I want to talk about what that means to me. We have cranky paper clip already. So interest rates are going to be hopping. JK, same stagnation. We're going to dwell on that a little bit. I want to share something. It's kind of funny. YouTube has, in the comments that people make, YouTube sometimes determines that they're not appropriate. Either they don't meet their community guidelines or they use profanity. So they put it in a bucket called held for review, which I go in and look at. I can decide to go ahead and approve the comment. So if I get some really nasty comments, I delete you, be nice. So if you're going to come after me and you're going to be mean and everything, chances are your comment's not going to show up. But for the most part,
why would anybody be mean to you?
Oh, there's a whole bunch of them. So anyway, I got this comment under held for review, and I'm not going to share the YouTuber's name. I'm just going to share the comment. Here it is. Help me out, folks. Same thing. What behind your moms, man? Deep intellect right there. They're put the scotch down. I mean,
the computer warrior.
Yeah, I kind of left that one back in the bucket there. I'm not going to do anything with it, but a couple quick ditties to let you know where we're at here as we get started. There were 6,059 closed transactions, down 1.5% from last year, but up 2.1% from September. And there were 1,272 closed homes, down 15.4% from last year and down 3.1% for September. But the big shocker is the resale market managed to grow 3% year over year, but the new home market lost over 15% in transaction volume. That's why we're starting to get these emails of 3.75, 5% agent co-broke and all that stuff. They're turning the heat up, my friend.
Yeah. I obviously pulled that one article up we can show later on about the home builder.
Yeah. This is active listings. Now, we hear that average for our market is 27,000. Okay, so you're going to glean an average out of this. Boy, I got the sun beating right in my face right there. So 27,000 is about here, and that's average. But in and of itself, it doesn't really mean anything. It's like, okay, well, our market hits 27,000. That's to be expected. That's our average number of listings. But you're going to have to measure it with, the demand as well. Now, Cromford Report was saying that, active listings are climbing, but they neglect to add that that's temporary because they're going to go down. They go down every year in November, December. So there's no reason to expect that they're not going to do what I just drew there. So this is the week that they stop climbing. And I'm seeing it in my 7-day moving average, Pat, because, the first of the month, we always end up with about 1,000 expireds. So that's whittling away a little bit at the listings. But the important thing to measure is, okay, I get that we have an average number of listings here at 27,000, but our sales are nowhere near average. They're 2,700 every 7 days. We're running about 3,800. If we were running 3,800 now, we'd be an incredibly balanced market, but we're not because the sales are so low. So looking at an average, it doesn't really tell you anything. Listing success rate by calendar month shows us is 71%. That's not too bad. Mm-hmm. I went through different price points, Pat. I drilled through this chart here, and I went through different price points in different cities. Everybody's kind of hugging in at about the same success rate. I thought maybe I'd see a standout
Mm-hmm.
in certain price points that just aren't doing that well. And that's typically in the luxury market, but it has wild swings. So nothing alarming there. Here's our pending listings, that chart that matches week after week, except for this week. Look at that. We went up from last year at 39.43 to 42.48. So while people tell us nobody's buying, well, they are. They're just not buying as much as they did. Here's new listings by calendar month. It kind of shows you what happens seasonally. I just showed you that listings are going to go down November, December. And here's where we're at on average. This is actually last year right here, December and November. So they're gonna go down.
Mm-hmm.
This is our Cromford Market Index, and it's showing a lot of red. And it's showing you that there really haven't been that many cities improved for sellers. That would be green, except Fountain Hills and Chandler went up a whopping 1%. But they're hanging in there as a healthy seller's market. And this is in the newsletter that we send out every Monday morning at 7:00. It's right here. You can get that, the link below. You can get what Cromford Market says there. You can take a look at mortgage rates. You can get Pat's McMortgage tidbit, and in my opinion, it's bottom. But you can also get a detailed market report. And I wanted to show people kind of what that looks like when you click on that tab, because we're only getting about 2 or 3 people look at that, but it's very detailed. Shows you a lot of what's going on in our market. So sign up for the newsletter. We don't spam you, and you'll get that stuff. This one creeping up a little bit in percent of closings with seller paid contributions, concessions. Didn't creep up as a percentage, but it went up from 10,000 to 11,555.
Interesting.
That kind of surprised me. Article here says buyers are ghosting the housing market, and here's why. None of this is a surprise, saying although the lack of government released economic data amid the ongoing shutdowns making it difficult to gauge the health of the economy overall, one thing is clear: national home demand is weak, even as mortgage rates are bouncing around the lowest levels of the year. So there's job worries are outweighing the lower rates. The other thing that we're seeing going on, and you know this just as well as anybody, is that while we're getting these lower rates that are helping with that payment, it's being offset by insurance.
Yeah. Insurance, taxes. I mean, once again, you look at the inflation rate, they say it's around, say, 3%. You and I just feel like it's around 10 or 15%. Nothing in the grocery store has come down. I mean, I was just talking to a broker friend of mine at Realty One in Chandler, and he's like, he was ticked off because his regular coffee went up from like $14, $15 to like $22, $23. Even I noticed even at Costco, the Folgers that I buy at Costco, usually it was like $9, $10, $11 for that big red container of coffee at Costco. It's 17 or 18 bucks right now.
Yeah, I was at Costco this week looking at brisket because we usually make that, for Thanksgiving. $125.
Yeah. I mean, it's just, it's just crazy. There's so many.
Of course, the beef, there's definitely a beef shortage, and there's reasons behind it and stuff. But like, man, oh man, I don't know if remember. You probably didn't see the video I was talking. I was actually talking with the people at Zudelio. That comes out every Tuesday. They're really cool people. I was talking about listings that are kept in-house, like just on Compass's websites or just on this brokerage. And for the life of me, I don't know why someone would want their house listed and have it be exclusive with that brokerage. I'd want my listing in front of everybody, as many eyeballs as I can get.
Yeah.
And so they're trying to say that this is exclusive and it's great. Well, guess what? The numbers are coming out. Off multiple listing service transactions cost sellers thousands, a new report says. They indicate that the share of non-MLS listings is rising, and off MLS sellers lose significant sums. Sellers who list on the MLS gain nearly 19% price advantage over private sellers. That's huge, Pat.
That's huge.
So, if you list and somebody goes, well, we're going to put it on our exclusive page, you got to tell them, what are you, nuts?
Yeah. I don't know if it's because of the exclusivity, the boutiqueness of it. We're going to market your house a certain way and that's it. I just don't know what the
it all boils down to exposure and eyeballs. I mean, you can market it, you can do this, you can tap out a whole bunch of TikTok videos and everything, but if you're only going to be at an exclusive audience versus the entire MLS, because that's where listings sell, then you're going to have some problems. And here's the contract ratio is considered a cold market right now, 28.3, dropped from 30.2. So we're getting the holiday slowdowns coming here right now. And if I had a listing, would I pull it? No, I'd leave it. The sellers that are going to be out there in November and December now, the buyers, I'm sorry, they're going to be serious buyers. So they're looking for a reason.
Yep.
There won't be as many, which is probably okay because you don't want a whole bunch of people traipsing through your house on the holidays. But you're not going to gain anything by taking the listing off, putting it back in January when everybody else does the exact same thing. So stay there and compete, and you'll have less competition, fewer boots on the ground. But I don't recommend doing that. Now, what did you see? We saw a little bit of relief in rates today.
Yeah, I mean, we saw seems like the bond market's kind of found their post. This one article, this one caption said that bonds found their post-Fed footing. I mean, they're up 25 basis points today, so we came back a little bit. But basically the Challenger, this Challenger report that comes off talks about layoffs. In the Mortgage News Daily, it's 153,000 in October. Corporate layoffs versus 54,000 prior number. So rates have been really just kind of sitting there. I mean, pull back this is the 1 year, 10-year Treasury chart. I mean, obviously we're in this downtrend. We're stuck right here right now. So we saw a little pop up here the last couple of weeks, but overall we're still, I think, in this overall downtrend. But rates have really been devoid of any government data. So my problem that I have is when the government opens up, what kind of flood of data are we going to see? And how much volatility is it going to cause on rates?
Well, I agree with you. I think it's going to bounce around like a bullet in a metal room.
Yeah, I mean,
flood of data if and when they ever open back up, the dummies.
And the economic data has been very choppy. I mean, today we've got the Challenger layoffs. We had the market's been looking for any data that can find to try to make some type of sense of this. You got the tariffs, what the heck is going to go on with tariffs, inflation. You got the Fed, what are they going to do? Because they can't really make a firm decision based on any data that, the minimum data that they have. So obviously, are they going to cut in December? It sounds like they probably, we're going into the second week of next week. It's going to be, second week of November. So who knows when we're going to get this data? But, when we do get the data, it's going to be like a ping pong, I think, in terms of the rates. We're stuck in this range, but I don't see rates, getting out of hand. But once again, you never know. Hopefully the data, everything that it just seems that's compounding into there's not as much positive news out there as we'd like it to be.
Well, and then I saw, been reading a few things that's saying that the overnight repo rate, that it's Fed's put in 50 billion. And I've read, especially with, a lot of our viewers that make comments, very, they know their stuff. And so they pointed out, that actually it's been a good thing. The 50 billion, it's not a sign of trouble. But then you'll read somewhere else where it's, this is an indication that liquidity is really being a problem. So I'm kind of leaning towards what I've seen, that it's not that big of a deal. But it was a huge move, $50 billion, and haven't replicated it. But I don't see it doesn't look like a red flag to me. And based on some of the comments from our viewers that really seem to know their stuff, it doesn't look like it's a big deal. So while we're looking at the central bank deciding what the December cut going to be, aren't they doing an awful lot on the back end with the balance sheet and MBS?
Yeah, they're letting it roll. I mean, they're basically they're going into quantitative easing for the most part. But like I said, there's so many different, we're in just a very different time frame the last couple months that you can't really put your finger on anything. The Fed is kind of in a pickle right now. And based on that, I'm watching. Obviously, people can look at the Fed, but obviously, once again, we saw a couple of weeks ago where the Fed lowers rates and mortgage rates go up. So I'm watching what the activity is in the 10-year Treasury and the mortgage-backed security market. It's going to tell you everything. It's a daily way to track what is really kind of going on behind the scenes. So, because like the Fed only meets 8 times a year, so that's only 8 times that you're going to see what they're doing, but the market tells you every day what's going on.
Yeah, I think that's important that you say that too, because I know I had a really good friend call me this week talking about the rate cut and said, what do you think they're going to do in December? I said, I don't think it makes a difference to you, because he was talking about he wants to get a home equity loan on a place that he's currently building. He's almost done with it. And so he was asking me about adjustable rates. And I said, well, get with your lender and talk to them, but don't hang your hat on the Fed, whether they cut 0.25 or 0.50. There's way more things to look at than the headlines. He said, well, Trump wants to go down 3 points. I said, well, ignore that.
Yeah.
That ain't happening. He can want to do that all he wants, but he's not the one. It's the bond market that determines where things go. I mean, he can give speech after speech. This is what I want. And the bond market's going to go, well, I'm happy for you. However, this is how we're trading the market right now. And then speaking of HELOCs, you were telling me this morning about a new program, relatively new, that's out there. You want to let us know what's going on with that?
Yeah, I mean, I've been digging into HELOCs the last couple of months, obviously, because it's people are looking, calling. I've gotten some inquiries about it, but there's this one company that's got a HELOC that basically is great for self-employed people. It's a quick and easy. The rate's a little bit higher, but I've got about 5 or 6 different HELOC lenders now that I really feel comfortable with. I didn't have these options about 2 or 3 years ago, so I never really talked about HELOCs. But in the broker side, they've come out with some pretty good, interesting programs. I've got HELOC program, but this one is great for like self-employed borrowers, because there's all you have to do is fill out a small. It's about 5 or 6 things. Get the application started. You do it online. You basically upload your personal and business bank statements. There's no tax returns, and they just verify your income that's in your personal and your business bank statement. And there's no appraisal. There's no CPA letter, no tax returns, and so people can get their money in like 5 to 7, 8 days. So it's a pretty nifty little program for people that are looking at, that might be self-employed, that write off a lot of income. And I've got other HELOCs. That rate is high 8s, low, mid 8s, high 8s, 9s, depending on your loan to value and your credit score. But then I've got other HELOC programs too that I've got rates in the 6s for, but that takes time, because you got to get appraisal. It's a full underwrite, appraisal, title. That takes about 25 to 30 days. But this one that came out, the reason it came out, they used to just use personal bank statements, but now they're using personal and business bank statements. So it's perfect for, like I said, a self-employed borrower, real estate agent, somebody that's maybe self-employed, 1099. They don't dig into the tax returns. So it's a pretty quick little nifty program. So I know a lot of people are looking at equity. They're at 2.5 or 3%. It certainly can't hurt to take a look at different HELOC programs. That's why I've been digging into them a little bit further, because I know it's a product line that I never really delved into a couple of years ago, but now I've got access to 5 or 6 different HELOC lenders that are really got great rates and a lot of different flexibility on another program too. So
yeah, that helps that they don't have to do the appraisal or dig in the tax records, because smart business person writes off as much as they can, and they're going to look and go, oh, but then yet you're shoving all this money through your checking account. Oh,
Yeah.
okay. Legitimate. So,
Well, I've got one going
yeah.
through right now. They just opened up their business less than a year ago. And typically, lenders, credit unions, they want to see 2 years tax returns and everything else. It doesn't matter. Just basically what's your personal and business bank statement. They might look back 6 months, 8 months. It just depends how much. The lender told me it just depends how many bank statements the bank will allow them to upload. But yeah, this one couple, they had their business. They were a little over a year, so they would have probably been stopped out at a credit union. But we're going through with it, so they're happier than hell.
That's cool. Well,
Yeah,
just, people just get hold of Pat if you're interested in something like that. And realtors
yeah.
too, if you want to know what he's got, just grab him.
Well, no, another thing is too for realtors that that actually just jump in quick. I mentioned to realtors for people that maybe bought cash for their paid cash for the house. Maybe they put $600,000 down on cash and they want to, instead of doing delayed financing to take cash out, they could do a quick HELOC. There's no seasoning on this HELOC, so it's pretty quick and easy. So
I read this kind of be interesting for realtors as well. If you're ever out showing homes and you're using Google Maps, Google Maps navigation gets a powerful boost with Gemini. And basically, what Google Maps now does, you'll be able to take a picture of a building in front of you and it'll tell you what the building is and where it's at or where you're at. But when it comes to navigation, what it's going to be able to do is, instead of when you look at the map, it shows you the streets and it shows you a stoplight and everything. And you can turn on the, the navigation to talk to you, take a left at 136th Street. Now it'll say, your turn is 300 feet in front of you at the Taco Bell. So it's going to actually let you know what landmarks are around where they want you to turn. So it's, you're driving a car at 300 feet. That means nothing to me. 300
yeah,
feet, I see two streets. Is it that one's this one? And I got to look, and this is going to tell you, turn left at the Taco Bell. And so it's
it sounds like directions that you get back up in Wisconsin. It's like, well, you go about a mile down the road when you see the red barn, take a left, and then you go down, you'll see the white church on the about a half a mile down, take a right there, and it'll be right, the house will be right there, right in front of the church.
yeah. And take two rights. I never know whether I'm supposed to count the first one, but it is better than what Yogi Berra said when he was given directions to his house, and he told his friend, when you come to the fork in the road, take it.
Yeah.
So, but navigation, I mean, the AI, I get a newsletter every morning called Superhuman, and it just rolls through all these new AI programs and things that are coming and stuff and design things that they're working on. And some of it just makes you scratch your head, but Google is adding a lot of, I think, useful stuff using Gemini. Now, as far as real estate and artificial intelligence, it's good at doing some decent market research, but I still find that you've really got to stay on top of the numbers. You'll pull things, you got to go back and double check it with the numbers.
Yeah.
So I've seen some that I've pulled that said that this area had 5% appreciation. I knew right away that was wrong. And so I did another poll. It still didn't correct it. It formatted it nice, and that's those zip code reports I sent out, which is that QR code up there. So I went and changed the numbers based on the actual data I got. And what I use the AI for is not so much the data, although 95% of the time it comes back accurate. It's how they format it,
Yeah.
and how it's easy to read, which would take me an hour to type out for somebody, if not longer. So I use AI to pull the numbers. I get into Cromford, I do a deep dive, I look at the numbers to see if they're accurate, and if they are, then I'll spit it out. And then I can also go into Chat GPT, put in the same information, see what they've got, compare the two numbers. So it's making my job easier as far as data analysis and presentation. I like being able to, and those that have already got zip code reports from me got a report yesterday, just simply called the November market report, where it gives you a pretty deep dive into where we're at today. So I don't spam you. You'll get your zip code report, and then once a month you'll get an update, overall market. If you want an updated one just for your zip code, you'll have to send me an email at rick@rickhelps.com, and I will answer. I do answer. Hi, Jackie. I do answer every email I get. I don't respond to every comment that I have on YouTube because some of them are head shakers, but some of them are fantastic. So, I enjoy doing that. Oh, I don't know what to do with the one I got this week. So maybe you folks can help me with that same thing. What behind your moms? And but Pat, there's really no news coming up this week. Once again, I mean, we're just sitting back here going,
Yeah, I mean, it's going to be. I mean,
Mhm.
on the rate side, I mean, we've gone from 5.99 to just talk back to rates 5.9 to 6, back to around 6.8, 6.25. But it's going to be difficult to get a handle on where rates are going to be, obviously with this shutdown. So, like I said, you got the tariff talk. What's going to happen there? I don't see the rates moving any higher. Certainly could change with the information that comes out from the shutdown, but I the data that comes out from the shutdown, I think is going to be more negative than positive. That's my take on it. I don't. I could be wrong. We're gonna have to see what the labor, all this labor market data is coming in. So really, right now, I mean,
well,
today was a good day.
it's
Today
year
was a
end
good day with the
closeout.
rates, huh?
It's year end closeout month with new builds, and man, I'm getting some wild emails.
Yeah, I mean, look at that one article that I pull up. Home builders bet on 1% mortgage rates to wake up U.S. buyers. So, I mean, I didn't do a real dive on this article, but obviously they're subsidizing mortgage rates. I'm just curious. I saw something about how FHA, them baking in the buy down with the price of the home, how
Hmm.
that's gonna affect a home a year, 2 years down the road. FHA, the values, because am I wrong in saying they're kind of artificially baking in some stuff that probably should be baked into the price?
Well, I think that's healthy because I mean, yeah, I mean, just think of it in the simplest of terms. I got a great rate buy down. I got all these. They gave me all this money. They discounted the price of the home and they gave me $30,000 for improvements. If I were to try and turn around and sell that home, I'm not going to be able to offer those improvements. I'm not going to be able to offer you that rate buy down.
Yeah,
There's a cost associated with that. It's probably 50, 60 grand.
yeah,
So I'm coming out upside down right off the bat. Now, if you're going to stay put, and you got this great rate buy down that's 30-year fixed, you're going to be fine. Just hang in there. And but if you have to move in 2 to 3 years, I wouldn't touch it.
yeah.
I mean,
I'm trying to see some
I would
articles on
not
that.
touch a new build rate buy down if I think I have to move in less than 3 years.
Yeah, because I've seen and read different articles where people are like, okay, I'm need to sell 2 years later. It's well, good luck.
Yeah.
So that's the dilemma that you get with these. There's always a cost with these, and nothing's free. Nothing is free in life, and that's going to come back. Like I said, these down payment assistance programs, I try to stay away from because there's fees and the rates are higher, and there's liens or second liens that are attached to them. Some are grants that are forgivable, but when you do a down payment assistance program, you have to really dig into the details to make sure you're getting what you're getting is sound, because it can leave you upside down and you could be stuck for a while.
Well, I'm looking at like this year. I mean, the black line, that's the number of contracts on a 7-day moving average. It hasn't budged. There is nothing going on between now and January that's going to move that at all. It'll have a couple big dips in there because of the holidays, but there's nothing out there that says, "Oh, it's 2,700. It's going to go to 3,500."
Yeah,
It's just not. Now 2,700 isn't. It's slow, but it's not bad. I mean, it's not dead. Thanks, Jeff. I mean, it's just
hey Jeff.
people go, nothing's selling. Well, we're moving 2,750 homes a week, so something's selling. The high
Yeah,
end's doing very well. Some areas of town, like Chandler, are doing great. So it's not woe is me. Maricopa's struggling if you're a resale. They're at the bottom, and so, but as I hear people saying, well, the first of the year, and I was on with the Zudilio folks talking about next year. I don't make long-term projections. I go, well, let's play a little bit. I said, I think January and February is going to be just as disappointing in volume as it was this year.
Yeah.
And they agreed. And of course, Jason said, well, I think things are really going to change in May when we get a Fed chairman. I'm like, I don't know. But there's a lot that can happen between now and May, regardless of a Fed chairman, just based on bond market moves and mortgage-backed securities that can change things up. But it's nothing's happened in January and February that goes, here we go. It's the only thing we can count on is more listings. People going, okay, we're going to give this, it's a new year. Let's go.
Yep. Because everybody comes back, beginning of the year, they're optimistic. This is going to be a killer year. We're going to crush it this year.
Crush it. Yeah. How many years have we banned that word?
Yeah, it's been a couple of years since we've heard that word.
People aren't using it. I'm not hearing marry the house, date the rate much.
No,
I am.
A lot of divorces.
I'm seeing a lot of comments. A lot of comments about when rates go down, the floodgates are going to open. Nope. I mean, rates could go down to 5.9 today, Pat. We'll go from 2,750 to 3,200.
Yeah.
And so it'll maybe reach at parity with the new listings that we got coming on. But if you know how real estate works, your neighbor says, hey, I hear things are really picking up. You're going to list your house. So the gap between number of homes sold and number of new listings coming on will remain the same. They will both grow equally.
Yeah.
So I just don't statistically see anything moving the bar. Now we've got a huge affordability issue that's just going to take time. That's not going to be solved Q1 or Q2 of next year. And despite interest rates going down, we need relief in insurance rates. I don't know what solves that. Taxes in some states are driving people crazy. Could prices on homes plummet? Well, that's always out there, but they could also level out and continue coming down gradually. We've seen depreciation of 15% between $300,000 and $800,000 in our market since the peak of 2022. How much farther down we're going to go from that? I don't know. I really don't know. So that's why I like to get on here and look and say, okay, what are we seeing? And then with you looking at the rates and stuff, there's just nothing that jumps out that goes, ooh, watch this carefully.
Yeah.
And so I think, it's going to be a very, very interesting market.
I think if we get any type of negative news coming from the data, once it's released, once again, we were flirting with 5.996. I was talking to Jeff about, certain things on his situation, but I'm looking at like mid fives. The discount rebate to get down for this one lender is 2.25%. That's basically kind of rates have to get down about 2 points in pricing in the bond for the most part. I'm just being general about this, but if we can get high fives consistently, it certainly rates floated from 5.996 to 6.25, 6 3/8 range. They can float back just as quickly, but to go down really low in terms of mid fives, it's going to take some work from there.
Yeah. It's not a healthy market. It's not a dead market. Agents are staying busy. I know Jackie, she's working her hind end off. She's got a lot of stuff going on. So it's not, it's not the end of the world out there.
It's a bifurcated market.
I got a kick out of a comment that I saw the other day that said something about realtors and pricing. And I always comment the same. I go, we have no impact on pricing, folks. I mean, collectively as agents, the market does that.
Yeah.
I always kid about having our price fixing meeting at Cracker Barrel at the third week of every month. But we can't do anything about pricing. We can, but you're going to encourage them to list the house high. Our job is to get you what you want. Get you the most we can for your house. I have no incentive for you to overprice. That just means I'm going to spend money and the listing will dry up and my checking account will go down because it costs money to list a house, and not to mention the time and expenses of doing that. So I don't have any incentive to say, well, it looks like it's worth 500,000, but let's try 560. That's just real estate suicide.
Mm-hmm. Yeah.
So we won't do a show next week because there's not going to be anything earth shattering happening. So people, they're just going to miss you, Pat, and
I know.
let you know because we don't want to. We're on the fringe of being boring. I don't want to push the envelope.
I know. Thank God we changed this from every week to every 2 weeks because
Yeah, that's right.
God forbid if we, I know Dan Frio back in Chicago does a show every day, and God love him,
Yeah, he does a rate update. He's in Florida for about 2-3 weeks. I'm trying to hook up with him, trying to get the schedule to get that
Cool.
down. But probably say the same thing. Yeah, nothing's changing. We're all waiting. Need the government to open. So
I did see something. If I could pull this up real quick here this morning, I should have had this ready, but there's some news out that we got. There was one. Bear with me 1 second if I can find it quick. I probably won't be able to. But suppose, Sean, there's a Fannie Mae update. Thought this is interesting. He said, bear with me, folks. Here, it's kind of mortgage talk, but Fannie Mae, it says minimum credit score requirements will no longer apply to loans submitted to DU, which is desktop underwriting. The selling guide has been updated to align with changes previously communicated in the DU version 12.0 November update. Specifically, DU will no longer apply a minimum credit score, but will rely on its own comprehensive analysis of risk factors to determine eligibility.
I read that.
And DU, that's what happens in our mortgage. Just to go back, talk a little bit, mortgagees, that's the problem with the guidelines. The lenders and the government can tighten up guidelines within every version. So 2 months ago, if I ran a certain scenario case by, everything's case by case, file by file, because I can run a file and it could get desktop approval, 740 FICO score, but their high debt to income ratio, say a 47, 48%. But then all of a sudden, 2 months later, you run the same scenario and you're not getting an approval because the government can tighten up within month to month or versions of the algorithm, how they want to see loans. And you see that once in a while because you'll see mortgage people bitch about, I can't get this file approved. I ran it 2 months ago and it was approved, eligible, but now I can't. That's how they can tighten up indirectly behind the scenes, their algorithms. But here it said, basically, in addition to these revisions, we have updated DU non-traditional credit documentation and homebuyer education requirements to no longer rely on credit scores. Instead, DU will issue a message where lenders establish a non-traditional credit history and or a complete homebuyer education where no borrower has at least one credit account. It says the minimum representative credit score requirement of 620 for loan case files for one borrower and a minimum average credit score of 620 for more than one borrower will be removed for new loan case files created on or after November 16th. So we'll see what that means. Basically, I don't know if they're saying, because the minimum for a conventional loan was 620. So now it's, from the way I can read it, they're going to take that away and kind of, we'll see because you're going to have lender overlays with every lender. So I'm going to read, I'll keep people posted on that, find out more about it. It just came out. I saw it today on an email. So we shall see. I think there's stuff that they could do on the home, just to kind of reflect real quickly here. I think there's stuff that they could do behind the scenes. The last couple of years, people have been through different trials and tribulations individually with jobs, getting 2 jobs. We get our butts kicked in when you have 2 jobs and people have, they have to be on that second job 2 years. I think if they can loosen up some of the requirements on that, and if we could show a file underwriter the positives in a file versus just the strict guidelines, I think you can open up because there are people there who've got low credit scores maybe, but still could, buy a home or want to buy a home, but they're restricted by the guidelines. So,
well, landlords have done that a lot. They looked less on credit scores and more on just simple payment history.
Yeah.
I would talk to people that, that had rentals available, and I say, what are you looking for? They go, payment history. What about credit score? don't really care. I mean,
Yeah.
there's different reasons why your credit score can get hammered. Maybe you're not staying up
Well,
with your
that's
credit card or your car payment, but if I look at your rental history and you haven't missed a payment in 2 years, I'm good.
yeah. I just wish they'd put on the onus on the loan officer to document a file because I've had borrowers before. They wanted to buy, but they couldn't buy it for one strict guideline or the other. I wish they would open up. You could probably see a million plus people being able to buy a home if they just open up the guidelines, not to be loosey goosey like they were in 08, 09, but just have some more common sense. Some of these times, these FHA guidelines, they do let things, they're a little bit more looser on the guidelines, but yet they're strict in other ways that it doesn't make any sense. So,
Well, keep in mind, you just used the words common sense and government in the same paragraph.
that's right.
So,
That doesn't.
we'll see how that works out. So,
Well, that's why I'm
well,
hoping that Bill Pulte from FHFA gets in there, and I think he has actually hired Barry Habib from the mortgage industry to look at pricing. They're looking at the loan level pricing adjustments on
Yep.
cash out and second homes, because the loan level pricing adjustments the last couple of years have been really stupid in terms of adding on. Sometimes it's a half a point add on. A $300,000-$400,000 home. That's it's a fairly sizable difference.
Yeah, it'd be great to see some simplicity too. So,
Yeah.
all right, my friend. Well, I'll see you in a couple weeks, huh?
All right, buddy.
See
Take
ya.
care,
Bye
everybody.
to our millions and millions of viewers.
You got it. See ya.